In December 2009, the global financial system was still in crisis. The market had bottomed a short 9 months earlier, and the fear of a double-dip recession was palpable. With the world still on edge, one high-ranking United Nations official came forward with a bold assertion. The world financial system was saved from collapse by $352 billion of illegal drug profits propping up several key international banks. Antonio Maria Costa, the head of the UN Office on Drugs and Crime, told The Guardian at the time that this funding from drug cartels was the only liquid investment capital available to these struggling institutions. He did not name specific banks or specific transactions, but claimed to have seen evidence from intelligence agencies and government investigations. Costa even went so far as to imply that by propping up those key international institutions, the entire financial system was kept afloat. Antonio Maria Costa, head of the UN Office on Drugs and Crime, said he has seen evidence that the proceeds of organized crime were the only liquid investment capital available to some banks on the brink of collapse last year. He said that a majority of the $352 billion, PS $216 billion, of drugs profits was absorbed into the economic system as a result. This will raise questions about crime's influence on the economic system at times of crisis. It will also prompt further examination of the banking sector as world leaders, including Barack Obama and Gordon Brown, call for new International Monetary Fund regulations. Speaking from his office in Vienna, Costa said evidence that illegal money was being absorbed into the financial system was first drawn to his attention by intelligence agencies and prosecutors around 18 months ago. In many instances, the money from drugs was the only liquid investment capital. In the second half of 2008, liquidity was the banking system's main problem, and hence, liquid capital became an important factor, he said. Some of the evidence put before his office indicated that gang money was used to save some banks from collapse when lending seized up, he said. Interbank loans were funded by money that originated from the drugs trade and other illegal activities. There were signs that some banks were rescued that way. Costa declined to identify countries or banks that may have received any drugs money, saying that would be inappropriate because his office is supposed to address the problem, not apportion blame. But he said the money is now a part of the official system and had been effectively laundered. This was the moment, last year, when the system was basically paralyzed because of the unwillingness of banks to lend money to one another. The progressive liquidization to the system and the progressive improvement by some banks of their share values has meant that the problem of illegal money has become much less serious than it was, he said. The IMF estimated that large US and European banks lost more than $1 trillion on toxic assets and bad loans from January 2007 to September 2009, and more than 200 mortgage lenders went bankrupt. Many major institutions either failed, were acquired under duress, or were subject to government takeover. Gangs are now believed to make most of their profits from the drugs trade and are estimated to be worth PS $352 billion, the UN says. They have traditionally kept proceeds in cash or moved it offshore to hide it from the authorities. It is understood that evidence that drug money has flowed into banks came from officials in Britain, Switzerland, Italy, and the US. British bankers would want to see any evidence that Costa has to back his claims. A British Bankers Association spokesman said, "We have not been party to any regulatory dialogue that would support a theory of this kind. There was clearly a lack of liquidity in the system, and to a large degree, this was filled by the intervention of central banks." What really saved the financial system, in other people's view, was the unprecedented responses from central banks and governments around the world. From September to November of that year, the Fed increased its total assets by $1.3 trillion. That alone is 3.7 times more money than the $352 billion of drug money. Coordinated stimulus program designed by the world's central banks to lower interest rates, jumpstart spending, and backstop the financial system. A 2011 The Government Accountability Office report found that by the end of 2008, the central bank had loaned more than $1 trillion to banks to unfreeze the liquidity crisis. In 2009, the US government executed massive purchases of mortgage-backed securities, many of which were considered toxic at the time, to remove perceived risk from banks' balance sheets. That move successfully reopened the interbank lending banks rely on to fund day-to-day operations. On top of all that stimulus, Congress was also hard at work. Federal Deposit Insurance Corporation insurance was expanded. Fannie Mae and Freddie Mac were explicitly backed by the government after falling into receivership. TARP, TALF, and a host of additional legislation backstopped individual banks and the system itself. The list goes on. Together, these programs totaled trillions of dollars in rescue funds and bailouts, while also attending to the psychology of the markets. By comparison, that $352 billion in drug money hardly makes a dent. Understanding what happened in 2008 and 2009 is critical for investors. In many ways, the systemic failings and the overwhelming response define how the financial markets work today. Banks have now deleveraged to much more reasonable levels. Capital ratios are strong, and with the new LCR regulations, banks are better prepared for future shocks to liquidity. The causes and solutions of the crisis are much clearer today than they were in 2009. Costa was not wrong about the cause of the financial crisis or the mechanics of how the global system so quickly fell off the cliff. And his assertions about those few banks could very well be true, though we'll likely never know for sure. Regardless whether Costa was right or wrong, this story is an opportunity for us to step back and examine our own biases and how they affect our decision-making. That means making sure that what you're hitting with your hammer is actually a nail, and not something else entirely. This was all from us today, folks. For more similar content, make sure to subscribe to the channel. See you in the next one.